Many of today's most successful traders and investors credit their study of history as being the secret behind their uncanny ability to anticipate and capitalize on market responses to external events. In his latest book, titled Panic, Prosperity, and Progress, Tim Knight talks about this, and I'm pleased to introduce him. Tim, welcome to the Index Investing Show.
Thank you for having me.
So let's begin with financial history. Does it really matter? Why should today's generation of investors care about the past?
Well, in this day and age, as technology progresses, it's very easy to get seduced into the idea that what happened 2 or 3 years ago, or 20 or 30 years ago, and certainly hundreds of years ago, is completely irrelevant. I mean, people today look down, and if you've got an iPhone 4 instead of the iPhone 5, they assume that we're constantly in a state of learning and knowledge is cumulative. But it's really not, because, we're all born into this world ignorant, and our parents try to teach us, but we largely ignore them. And the lessons of history are really just partially absorbed by a few. And so my sense is that humans and their behavior really haven't changed that much over thousands of years. And even though people in the year 1600 would be completely bedazzled and flummoxed if we brought them into our world and showed them things that we're accustomed to, the way that we think and the way we regard risk and opportunity, I think, is really no different than it has been for millennia.
Tim Knight joining us. He's the author of a brand new book titled Panic, Prosperity, and Progress, 5 Centuries of History and the Markets. It's available at Amazon.com. Go pick up a copy. Now, leverage can be a powerful ally. It can also be a deadly enemy. You write about the Hunt family, who in the 1970s and early 80s became one of America's richest families, but then they lost everything. So what did the Hunt family do wrong, and how can we learn from them?
Well, it was a really astonishing story, and what's remarkable about it is how long they were right in what they said, because they had made their fortune in oil. They had made one of the great discoveries in Saudi Arabia, and their view in the very early 70s was that they had to protect their wealth and grow it to the best of their ability. And they were firmly convinced that surging inflation was on the horizon. And since the United States had departed the gold standard completely, and there was nothing holding the government back from printing money, that they needed to focus on hard assets. And you can understand the mentality. If you made your fortune in something you can hold and sell like crude oil, you're going to have an affinity for that. And so they began accumulating silver in small quantities at first, but as the years progressed, their investment became smarter and smarter looking. And the view that they could insulate their wealth from the ravages of inflation, which they very correctly predicted would be raging during the 70s, only egged on this notion that they had to amass huge quantities of silver that even the largest commodities exchanges in the world. And as silver went from $1 to $5 to $10 to $20 to $30 and kept raging higher, they just kept gobbling up silver, not just through means of their own cash, but also through a lot of borrowed money. Because as rich as the Hunts were, the quantities we're speaking of even challenged those kinds of fortunes. So they really increased their average price, what they paid for it, greatly. So although the silver they bought at $1 and $2 was wildly profitable, the kinds of masses of the silver they were buying when it was $35 needed much higher prices to be profitable. And what's kind of tragic about the story in a way is that the exchanges themselves stepped in brutally to stop this soaring market. And it reached the point where, although it's incredible to think of it, they forbid any more buying. Buying was literally not allowed. And that tends to put a stop to rising markets.
Yes,
and as things fell, as they fell, it accelerated. I mean, can you imagine today if it was illegal to buy a stock? That would tend to depress Apple's share price. So silver started to fall with even greater speed than it rose. And before it was all over, what had been one of the world's great fortunes was reduced to a few price horses in a stable and a bankruptcy court.
Yeah, a powerful lesson in the danger of over leverage. If you're just joining us, you're listening to the Index Investing Show. Pleased to be talking with Tim Knight. He's the author of a brand new book titled Panic, Prosperity, and Progress, 5 Centuries of History and the Markets. And I've read a lot of other books along this same line of taking a look at financial history. I can tell you that this is an outstanding book that's readable, unlike some of the other textbooks that precede it. Now, give us some context from your perspective between the frenzy of social media and biotech stocks today versus the frenzy of dot-com stocks in the late 90s. Where are we at in terms of the mania meter? Have we matched the previous era, or have we surpassed it in terms of sheer lunacy?
Yeah. Well, as much as I roll my eyes at the term "it's different this time," in a way it is different this time, but not in the sense that people usually mean. A friend of mine, were chatting over coffee about this yesterday, because I myself had built a company back during the internet bubble, although it had the freakish property of not having any venture funding and making money, and we did sell it. But he was a colleague of mine during that time, and he was asking me, how does the present mania compare to the internet bubble? And I would simply describe it as much more narrow but much deeper. And what I mean by that is, instead of hundreds and hundreds of rather ridiculously valued public companies that are rather small, you have a very concentrated handful of public and private companies that are extraordinarily valued. So to put a specific example on it, I don't think that WhatsApp would have been feasible even during the internet bubble. The notion that a company with no revenue, to say nothing of no profits, would be acquired for $19 billion would make even February 2000 inhabitants fall over dead with shock. But there's just one WhatsApp, as opposed to 100 items that are 1% that size. So it's a different form of mania, but the size of that concentration makes it just mind-blowing, even for our friends from 14 years ago.
In reference to the 2008 financial crisis, you write, quote, "The unknown outcome from the entire crisis is what will become of the staggering and persistent deficits the U.S. government is generating. The cure for the ills of the financial crisis may in the end require another cure of its own." End of quote. Tell us more.
Well, one of my favorite philosophers, as it were, was the late comedian George Carlin. And he put forth the idea that the United States public is really inured to the fact that anything will ever really go wrong. He called it the great American okey doke. And you can get used to that, because every movie you watch has a happy ending, and things just work out in the end. And as few folks in the U.S., I think, could articulate what is being done to prop things up right now, I think even those who do understand it can't articulate, and I include myself here, as to what the end game will be. I guess there's this vague general feeling that the economy will get so healthy that the debt's just not going to be a problem. And when you're dealing with a 0% interest environment, debt really isn't much of a problem. The thing is that there hasn't been a time ever that the nations of the earth have engaged in this cooperative and organized creation of credit to shore up what had been a financial disaster in 2008. And there are plenty of wringing hands about what might happen here. Will we go into currency wars? Are you going to see gold go to $100,000 an ounce? Are you going to see Weimar hyperinflation or something the world's never seen before? Even though I've written this 450-page book about all these different historical phenomena, I don't pretend to know where it's going to end up. One thing it seems everybody agrees upon is, well, we all know this is going to end badly, but we just don't know how. So I think the one lesson that everybody learned, particularly financial pundits, is to put in a quote that you can point to later that says that something bad is going to happen. You just don't know when. So I'm afraid I don't have a stock answer for you on that.
A fearless stock market is a dangerous place to invest, and one measure of fear is the VIX. And it's been rather quiet over the past several years. What do you make of the depressed level of the VIX and what it means for stock market investors today, Tim?
Yeah, it's interesting. The VIX actually peaked before the market bottomed. I mean, if we look at the VIX, the highest point it reached was on October 24 of 2008. And that was a full, almost 5 months before the bottom was actually reached. So the wheels seem to be coming off late in October. And what happened over the next couple of years was that people never really took their eyes off that rearview mirror. They were always worried about when that terrible thing would come back again. And so there was a couple of big spikes that were mimicking that panic, the first one of which peaked in May 24, 2010. I think that was the European crisis. And the next one was in August of 2011, which was our own United States debt crisis. After then, it has been a steady state of lower and lower and lower peaks in the VIX. So that fear has been getting systematically tamped down in a very regular fashion. And so people aren't really even bothering glancing at the rearview mirror anymore, because they figure that with all this QE, things are pretty solidly under control. What I've noticed as a technician myself, though, and as a very active investor, is that there is a very subtle change happening as we speak, which is those peaks in the VIX are getting a tiny bit higher each time now. So my view is that there is a little fear starting to leak back into the market, but as opposed to VIX at 90, when the VIX gets up to, say, 21, then it's headline news.
Yeah, and it's healthy, too, when you think about it, because you want to have some fear in the stock market. If there's no fear, then obviously it creates a dangerous type of environment where investors think they can't lose money. Now, let's move on to my final question. You know, it's easy to make fun of previous generations for being suckers for tulips or being suckers for overpriced stocks, Madoff schemes, onward, and so forth. Yet you make the great point that despite all of the advancements of our modern society, that human behavior throughout the ages has remained rather consistent and constant. Talk about that.
Well, yeah, my sense is that when we look back toward those manias, there's a subtle difference, because I don't think we really stared on our nose and think, how foolish past generations were. I think instead we think, oh well, we've wised. Those poor souls didn't have the information and the knowledge and the know-how and the experience that we've got, so we finally figured this out. And I think that the sort of amusing thing is that you never really know when you're in the midst of these things when the madness is peaking. Bitcoin is a great recent example, because we saw this creature go from $2 and $3 up to $1,300. And as a contrarian myself, it sort of pressed upon me that when everybody in the media was chattering about Bitcoin and that it equaled the price of an ounce of gold, that might have been a turning point. And it was. And it's lost about 55-60% of its value since then. I'm highly confident that in a few years we'll look back and point to, buying Oculus VR for $2 billion or WhatsApp for $19 billion, or any of these other firms that may ultimately go belly up that are in our internet space as new good examples of how wrong we got it. The thing is, though, that it is terribly difficult to know what the future might hold. If we took a time machine back to the year 2000 and we stood in the middle of the Sun Microsystems campus and we got a loudspeaker and said, "Attention, attention, Sun employees, all of you tens of thousands. We wanted to know we're from the future, and there is a pimply 17-year-old kid that's going to build a website that is going to completely take over the campus we're standing at here. Oh, and by the way, Sun won't exist anymore. Thank you, goodbye." And as bizarre as that might have sounded, that's exactly what happened. Because 2 miles from where I'm standing is this gigantic campus that used to be Sun Microsystems, and now it's Facebook. So I caution myself, contrarian as I am, to laugh at what might seem to be a incredible future, because some incredible things work out, and some of them go poof, and we can roll our eyes at them once it's already past us. But my hope in writing this book is to at least give people some sense that this is not the first time around the block for people getting passionate about something new and shiny.
The past is insane, and the future may be even more insane. You just heard from Tim Knight, author of a brand new book. It's on our recommended read list, titled Panic, Prosperity in Progress, 5 Centuries of History and the Markets. It's available at Amazon.com. Go pick up a copy. Tim, thanks for joining us.
super. I appreciate it. Thank you very much.
I'm Ron Delegge. This is the Index Investing Show, and I'll be right back.
The Index Investing Show with Ron Delegge.